Hello, everyone. Good morning. My name is Britton. I'm the co-founder at Syndicate Room, and I'm going to talk to you a little bit today about what we do and the data that we've analyzed to get there. So I promise not to be too much of a sales persona, but I have to talk a little bit about Syndicate Room. So Syndicate Room was a business that was set up back in 2012 as an online investment platform to allow people to co-invest in individual investment opportunities alongside business angels. So very much in the form of crowdfunding, but with the differentiation that each of our opportunities had a lead angel who was putting money into the round, set the terms of the deal, the valuation, all the legals, etc. And we were able to come in off the back of their hard work and let our investors invest alongside them. Since 2012, we've morphed the business from being a platform to a platform that had a sidecar fund to now just a data-driven seed to Series A fund. And that fund that we've created has used data predominantly from Companies House and places like Bowhurst, Crunchbase, and PitchBook to analyze the whole of the seed to Series A market in the UK. All of the companies that have raised funding rounds going back to 2011, how those companies have progressed, whether they've grown, whether they've shrank, gone bust, exited, and in addition to that, that trajectory that they've been on, and all the investors that have co-invested in those deals. Naturally, to get to this point where we have the data-driven fund, we have a lot of data. So in analyzing all of that, we've got several million data points. And most recently, we've started to highlight a few trends, at least in the last quarter, in what's going on with funding at Seed and Series A that I'm going to talk to you a little bit more about today. So there is good news. There's obviously bad news as well, as everyone said, but hopefully you find this useful. So the good news is that the angels are remaining fairly active. Actually, since lockdown started, we've invested in approximately 20 companies, which is great to hear. The bad side of that is that most of these companies were existing portfolio companies of those angels. So of the 20, about 15 the angels were familiar with and had invested in prior to the current round that they were going through. Only about 4 or 5 of them were new to the angel. And this is something that we've actually seen and everyone hears about with the later stage funds as well, and the VCTs, where the funds are putting money into portfolio companies to make sure that they have enough firepower or enough runway to get through the crisis and hopefully pick things back up when the market does as well. And that's the same in what we've seen with the angels. So primarily they're backing the companies that they think have a chance to make it. And only a few of them have kind of delved into new opportunities. Now, taking that one step further, we ran a survey of the angels in our network that we co-invest with. And there's approximately 50 angels that we are willing to co-invest with. In the response, we got about 25 responses, and only 2 of the angels had actually invested in a company that they had never met in person, which is quite scary to think. Going forward, though, the angels are very willing to change their approach. But in order to do so, and in order to be comfortable with investing in companies that they don't meet in person, they all feel that they'll have to speak with them much more frequently via, say, a Zoom call or Google Meet or on the phone. This is very important to the angels. And the other thing that's very important to them in investing in companies that they haven't met in person is trying to connect with someone who has met the company in person, whether it be a previous investor or current investor who has had that opportunity, and getting a feel for what the company's like and what the founders are like in order to make a decision. Of course, to these angels, the teams is the most important thing, and the team's ability to execute. So if they were unable to return to meeting the companies, they'd have to find ways around that, being comfortable with it. Now, one thing that all of the angels have said in terms of how they are going to approach investments going forward, despite having to have several Zoom calls, even if they could meet them in person, they believe that it will take a longer time to get comfortable and a longer time to make an investment decision, because even if you can meet in person, then the travel restrictions and their willingness to say, either get in a car or get on public transport, or arrange for the entrepreneurs to get in a car or get on public transport, is not less, but it does take more negotiating and more time to arrange those types of meetings. So one of the things that they have said, though, is that's a positive, I guess, is that they don't see that the pitch materials themselves or itself will change much. They still expect to see decks and financials, everything that you would expect to see more. But what will come into play more is your ability to present via a video call. And something else that came up is that actually what the Angels want to see or will want to be able to see is other members of the team. So if they can't visit the site where you and your team are working, or if you're all remote, it becomes more difficult. They do want to find a way of being able to interact with the wider team, or at least the senior team. So one of the clear messages is that when you're putting together these pitch materials, if you can include other types of media, so video footage, recordings, etc., of other members of your team talking about their expertise and their own history and what they see for the business, that will definitely add weight to your presentation and hopefully stand you in good stead to not have to spend too many Zoom calls getting the Angels familiar with the rest of the team. So it all sounds a bit doom and gloom, but I don't think it is. Yes, March was down for the industry. One of the things that we found in speaking with some of the other funds was that it was about 50% of investment by EIS went during March than what people were hoping for. We didn't see much of a recovery in April or in May, but June has kind of started off brightly with people starting to dip their toes back into EIS. And I would hazard a guess that because people will still have tax problems, July, August, September, months that would typically be lower months in terms of the EIS season will actually not be as slow as they were previously as people adjust to this new kind of environment. I hate saying that, but that's kind of the thing that stands out. So other things, I mean, what I can tell you is that if you are going to be going through a fundraise, bearing in mind that it will take longer to do any individual round, you should plan to raise more than you had initially planned to raise. So if you were looking to do kind of 12 to 18 months runway during a raise, you should actually try and go for 18 to 24 months to combat any delay in time it takes to do the next round. You never want to get to a round where you're nearly out of cash and then most of the power resides in the Angels' hands. Last trend that we've seen relates to valuations. So in most of the valuations where we've been investing during the lockdown, we are aware that the companies had initially intended to raise on a higher valuation, but because of the situation, they've gone down in valuation, not down rounds, although there have been many of those that we're aware of. But say a company was going out to raise at a pre-money 5 or 6 million valuation, what they probably ended up with was somewhere between 3 and 4. We saw, in addition, a lot of flat rounds. People talk about being depressed with down rounds and flat rounds. Don't be. It's kind of the norm right now. There are a lot of companies doing flat rounds. I believe the term they're using is a flat bridge to get to kind of next year, Q1, Q2, when they expect that market to pick back up again. And then hopefully they've positioned themselves in such a way that in Q1, Q2 next year, when the money's in theory going to start flowing again, they can then raise that larger round at the higher valuation that they were thinking that they might raise this year. So don't worry about flat rounds, don't worry about down rounds, get the money that you need in now to continue the business and keep you going until Q1 and Q2 of next year. I hope this is useful. Happy to answer questions when we get to the live session, and I'll speak to you soon. I might even have shaved by then. Bye.